Hello and welcome back to Financial Market Insights for Traders. I'm Sophia, and today we are diving into something that could make the difference between surviving the next market cycle and getting caught off guard. We are talking about how to stress test your portfolio for 2026 using one of the most important tools in modern investing, macro stress testing. Now, I know that might sound technical or something reserved for hedge funds and institutional investors, but stay with me. By the end of this episode, you'll understand how to apply it in a practical, straightforward way to your own portfolio. Let's start with the basics. Macro stress testing is simply the process of asking, what happens to my portfolio if things go wrong? Not slightly wrong, but seriously wrong. We are talking about scenarios like a deep recession, interest rates staying higher for longer, inflation coming back unexpectedly, or even a sudden liquidity crisis where markets seize up. Instead of assuming everything will be fine, you actively test your portfolio against extreme but realistic conditions. And this matters more than ever as we head into 2026. The investing environment right now is very different from what we saw over the last decade. For years, we had ultra-low interest rates, strong liquidity, and a rising tide that lifted most assets. That's no longer the case. Today, we are dealing with higher interest rates that affect everything from stock valuations to housing markets. Inflation is less predictable, and even when it cools, it may not return to the stable levels investors got used to. At the same time, markets are increasingly concentrated. A handful of megacap companies are driving a large portion of index performance. That creates hidden risk. And globally, things remain fragile. Supply chains, energy markets, and geopolitical tensions can all trigger sudden shocks. All of this means one thing: you can't rely on a set it and forget it portfolio anymore. You need to understand how your investments behave under pressure. That's exactly what macro stress testing helps you do. So let's walk through how to actually do this. The first step is getting a clear picture of what you own. And I mean really clear. Not just I have stocks and bonds, but a proper breakdown. Look at your equities by sector. Are you heavily weighted toward tech? Do you have exposure to energy or healthcare? Then look at your fixed income. Are your bonds short-term or long-term? What's their credit quality? Then consider alternatives. Do you hold commodities, real estate, or even crypto? And finally, how much cash or liquidity do you have? But here's where most people stop too early. You also need to understand what drives each of these assets. For example, tech stocks tend to be very sensitive to interest rates and growth expectations. Energy stocks are tied closely to commodity prices. Long-duration bonds are highly exposed to inflation and rate changes. This deeper understanding is what makes your macro stress testing meaningful instead of just guesswork. Once you've mapped your portfolio, the next step is to build realistic stress scenarios. You don't need dozens. In fact, 3 to 5 strong scenarios are enough, as long as they are well thought out. Let me walk you through 5 powerful ones. First, stagflation. This is where inflation rises above, say, 5% again, but economic growth stagnates. Central banks are stuck and can't easily cut rates. In that environment, bonds tend to lose value, equities struggle, and commodities often outperform. Second, a deep global recession. This would involve GDP contracting across major economies, unemployment rising sharply, and corporate earnings falling. In that case, equities could drop 30 to 40%, credit markets weaken, and defensive sectors might hold up better. Third, an interest rate shock. Imagine central banks hiking unexpectedly and yields rising quickly across the curve. That tends to hit growth stocks hard, weaken real estate, and put pressure on long-duration bonds. Fourth, a liquidity crisis. This is when financial system stress emerges and investors rush to cash. In these moments, correlations often go to 1, meaning almost everything falls together, even assets that are normally considered safe. And finally, an AI-driven market disruption. This one is more structural. Rapid productivity gains could reshape entire industries. Some sectors might surge, while others decline quickly. This leads to fast sector rotation and challenges traditional diversification. These types of scenarios form the backbone of advanced macro stress testing strategies for 2026 portfolios. Now comes the part where you quantify the impact. And don't worry, this doesn't need to be complicated. You can start with simple assumptions. For example, you might assume equities fall between 25 and 40% in a recession. Bonds might lose around 10% if rates rise sharply. Commodities could gain 15 to 30% during inflation spikes. Cash typically remains stable. Then you apply these assumptions to your portfolio. Let's say you have 60% in equities, 25% in bonds, 10% in commodities, and 5% in cash. Under a recession scenario, equities dropping 30% would create an 18% hit to your overall portfolio. Bonds gaining 5% would add about 1.25%. Commodities might fall slightly, say 10%, reducing your portfolio by another 1%. When you add it all up, you're looking at a drawdown of roughly 17 to 18%. That's how macro stress testing for diversified portfolios works in practice. It gives you a tangible sense of risk. But here's something even more important: correlations. This is where many portfolios fail. On paper, you might look diversified, but in a crisis, assets often move together. Tech stocks and growth ETFs tend to fall at the same time. Crypto can behave like high-risk equities. Even international markets often decline alongside domestic ones during global shocks. So your diversification might not be as strong as you think. One of the biggest advantages of macro stress testing for long-term investors is that it exposes these hidden correlations. Next, you need to think about liquidity. This is often overlooked. It's not just about how much your portfolio might drop, but whether you can access cash when you need it. Ask yourself, do you have enough liquidity to cover your expenses if markets fall? Would you be forced to sell assets at a loss? Are your investments easy to sell in a crisis? Because in real market stress, liquidity can disappear quickly. Then comes the psychological side. You might look at your stress test and see a potential 20 or 25% drawdown. The question is, can you actually handle that? Would you stay invested, or would you panic and sell? This is where many investors misjudge their risk tolerance. A good macro stress testing framework for individual investors doesn't just look at numbers. It also considers behavior. Once you've gone through all of this, it's time to take action. You might decide to reduce exposure to sectors that are highly sensitive to interest rates. You could add more defensive assets or include commodities as an inflation hedge. You might shorten the duration of your bonds or increase your cash allocation. The goal isn't to eliminate risk entirely. That's not possible. The goal is to make your portfolio resilient. Now, if you want to take this to the next level, using the right tools can make a big difference. If you're looking for a world-class, cutting-edge, user-friendly trading platform app, I'd recommend checking out crystalballmarkets.com/platform. It helps you track markets, analyze your positions, and make better decisions in real time. If you're serious about applying macro stress testing, having a strong platform behind you really matters. And just as important as tools is staying informed. Your stress tests are only as good as your assumptions, and those assumptions need to evolve as markets change. You should be keeping an eye on central bank policy, inflation data, economic growth trends, and overall market sentiment. If you prefer learning on the go, I highly recommend listening to iss.com/podcast/crystalballmarkets. It's a beginner-friendly podcast covering trading, investing, macro, and financial markets, and it's a great way to build your understanding without feeling overwhelmed. Before we wrap up, let's quickly go over some common mistakes. First, overconfidence. Assuming markets will always recover quickly can lead you to underestimate risk. Second, unrealistic scenarios. If your stress tests feel comfortable, they are probably not severe enough. Third, ignoring structural changes. The future won't look exactly like the past. And finally, not taking action. A stress test is only useful if it leads to better decisions. So here's the bottom line. Markets don't usually fail slowly. When things break, they tend to break quickly. That's why macro stress testing is such a powerful tool as we move toward 2026. It helps you understand your risks, uncover hidden weaknesses, and build a portfolio that can withstand uncertainty. You don't need perfect models. You don't need to predict the next crisis. You just need to be prepared. Start simple. Map your portfolio. Create a few realistic scenarios. Estimate the impact, and adjust where needed. Do that consistently, and you'll be far ahead of most investors. Thanks for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.